Hello, everyone. This is Tim Page, Executive Vice President of Digital Solutions for Builders FirstSource. Welcome, and thank you for attending today's Market Intelligence webinar. We're very excited to once again be partnering with Ali Wolf, Chief Economist at Zonda, to host a three-part webinar series with us in 2023. As we all continue adapting to a new housing market that is vastly different from just a few months ago, Ali will be presenting helpful insights and analysis to help bring clarity to where the market has been, where it is now, and where it may be heading. Additionally, we'll be hearing from BFS supply chain leaders Jeff Rettig and Steve LaValley with updates on what they're seeing within the commodities and building product sectors. Before I turn things over to Steve and Jeff, let me kick things off with a quick look at our BFS digital tools, which we are investing in to bring additional value to our home builder customers. In the first quarter, we launched our BFS digital tools, supported by our Take Building from Now to Next marketing campaign. There are 6 different offerings within our digital tools that you will learn more about in this short video.
Imagine if you had access to digital tools that let you build more efficiently, with greater transparency and control, and access to an experienced team of drafting experts who could turn your buyer's concept into a blueprint on demand. What if you could identify and eliminate construction clashes virtually before your project breaks ground? What happens when you streamline and enhance the design center experience, empowering your buyers to customize their home in a virtual 3D environment? How would your customers respond to immersive 3D tours of their future home in stunning clarity? What if you had access to an entire library of ready-to-build blueprints backed by stunning marketing assets? And imagine if you could access all these digital tools in one convenient place, where you could also upload plans, check order status, pay invoices, and more. Now you have greater control over projects, can better engage home buyers, accelerate the sales process, and streamline construction. This is the power of Builders FirstSource digital tools, powered by Paradigm, taking building from now to next.
We will deploy technologies that create value for home builder customers. We want to be a product and solutions provider. Our goal is to leverage technology to provide greater transparency to your projects, accelerate the sales process, and help you streamline construction. MyBLDR.com is a home building platform that we will continue to build throughout 2023. It will help connect the home builder's design, sales, quoting, procurement, and construction in one easy-to-use platform. MyBLDR.com currently includes 6 modules. The Plans module provides document storage and markup capabilities. Preview provides access to 3D models for home configure and frame walkthrough. The Materials module allows you to work with your BFS sales representative to review quotes, place orders, and view delivery photos. The Schedule module allows you to set your construction plan and view it in a list, calendar, or Gantt chart. Budget provides your BFS invoices and allows you to add other project costs. And the Cruise module allows you to control access to your various project participants. Finally, I'd like to highlight our 3D Home Configure product that can allow you to work with your home buyers on the interior and exterior selections that you offer. It allows you to shorten design time, better manage expectations, and provides peace of mind as you deliver dream homes. Home Configure includes capabilities such as lot selection, floor plan views, exterior product selection that can include palettes, as well as interior selections and walkthroughs, all from a computer or mobile device. Over the course of 2023, we will continue to develop these digital offerings. For more information, please visit our website, contact your BFS sales representative, or schedule time with one of our digital sales specialists. Thank you for your time. I will now turn the call over to Steve LaValley, our Vice President of Forest Products.
Thank you, Tim. I'm Steve LaValley, our VP of Forest Products for Builders FirstSource. So a commodity comment today is going to serve as a bit of a preview on something Allie's going to touch on later in her presentation. Wall Street Journal published this article last week on March 27th, titled "The Tale of Two Housing Markets: Prices Fall in the West While the East Booms." But this trend's also being seen in commodity prices. So looking at the Random Lengths indexes year to date, as published by Random Lengths, we can see on the right-hand side that the framing lumber composite, the very far upper right-hand side of that chart, we can see that Random Lengths composite was up about 12% year to date. But when we look at the underlying products within that, the Southern Yellow Pine composite, that's up 22% year to date, while the other composites are up 2%, 8%, 6%, 0%. And so really what that's showing us there, that products that are heavily centered on the eastern part of the U.S. are outperforming relative to the product on the east side. When we look at the OSB composite, the other slide was showing that the OSB composite is up 4% year to date, but we definitely see that Tale of Two Cities scenario playing out here too. So just taking two of the benchmark products here, the 7/16 sheeting in the Southeast relative to the 7/16 sheeting in Western Canada, which would be a proxy for Western business. We can see that in the East, prices have increased over 30% year to date, but while in the West, it's been essentially flatlined to a slight tick backwards. On the yellow pine, that slide is showing that there's about a 30% increase or over 30% increase year to date on the yellow pine, while when we look at the Western spruce composite, which is more heavily centered on the West and the North, even though after a brief rally in January, most of that trend has actually gone backwards in the meantime. So what could we might be able to anticipate going forward? I think watching the regional starts is going to remain very important this year. So softer demand in 2023 relative to the past 2 years has already led to range-bound prices and less volatility. We think current supply is adequate to meet demand at 1.2 to 1.3 million starts. However, producers will continue to curtail production to address any surpluses that develop. Additional capacity in Southern Yellow Pine is largely being offset by declines in the West, specifically Western Canada. And while there's additional OSB capacity planned to come online later in 2023 and 2024, we think there's question marks on if and when some of that capacity is going to be fired up. Continue to watch regional trends and starts and weather seasonality in the weaker markets. We think Western lumber and OSB could strengthen as weather and starts improve in the Western markets. And the overall watch point, starts trending above 1.5 million could begin to stress the supply base again, causing greater volatility, especially if a stronger single-family mix also starts to emerge. On that, next is Jeff Rettig, our VP of Building Products. Thank you.
Well, thanks, Steve, and hello, everybody. So one of the questions we're consistently asked about is which manufacturers have added capacity over the last few years to help builders out as we look forward. So let's go to the first slide. As we think about heading into spring and exteriors for new construction and remodeling, we're going to cover 3 vendors today that have added capacity and launched new products. The first one's Trex, the leader in composite decking. Trex added capacity in 2021 and are launching yet another facility that'll bring on additional volume in 2025. In addition, they launched the new Transcend Lineage line to give builders additional choices and offerings to home builders or to homeowners. The next slide covers LP SmartSide. Over the last few years, LP's converted a couple of their OSB mills to produce their SmartSide product line. Just last month, LP converted their Michigan facility over to produce SmartSide, bringing on even more capacity in 2023. Also, LP just launched 3 new colors in their pre-finished Expert Finish line to help builders out. And on the last slide, you'll see that James Hardie is heavily invested by adding capacity over the last couple of years at their South Carolina and Alabama mills. In addition, they have launched 2 new great product lines with the Magnolia Collection as well as the Architectural Collection to help builders out with their offerings to homeowners in the exterior of the house. From here, I'm going to turn it over to Allie Wolf, Chief Economist for Zonda. Allie?
Thank you, Jeff, and hello, everyone. I am pleased to be here to talk about the state of the housing market and wider economy. As we know, there are a lot of moving pieces in today's market, and I have 40 minutes to cover as much as we can. We'll have time for questions at the end, so please feel free to submit those as we go. Now, as mentioned, I am Allie Wolf, the Chief Economist with Zonda. If you're not that familiar with Zonda, we are a housing data and consultancy firm. We track the entire building life cycle from raw land all the way up to the closing out of new home communities. Our proprietary data at Zonda comes from the new home space, but we know to make sense of the broader market, we also have to look at existing home trends. What's happening in the economy? What's happening in policy? What's happening in different markets across the country? We're going to focus on each of those in today's presentation. 4 sections. Give me about 10 minutes to go through the economic backdrop. I think there are a lot of moving parts that we need to just understand before we move on to the current housing trends. You heard Steve mention the difference between the East and the West. We'll talk a lot about those regional differences and comparisons. And then I'll finish with a quick hit on remodeling and some of our final thoughts. So as we dive into the economic backdrop, let's just step back. If you look at the US economy right now, we have 2% more jobs than we had going into the pandemic. We've had 2 stellar jobs reports to start the year. 500,000 jobs added in January, 300,000 added in February. Our report for March comes out tomorrow, so make sure you're watching that. Expectations is about 200,000. If we look at the unemployment rate nationally, we moved up from 3.4% to 3.6%, partly because of the layoffs, but I'd say more specifically because more people have re-entered the labor force. So that's actually a good reason to see the unemployment rate trend up. But if you're a policymaker, I think us as people can say, hey, this is great, we have more people working. From the Federal Reserve's point of view, they're thinking back to the 1970s. They're thinking back to their dual mandate, maximum employment, price stability, and they're saying, hey, we thought we were at maximum employment, but some of this economic data continues to come in stronger than what we would expect. They see that in the labor front, and then they're also tracking it with inflation. Now, inflation, 2 major ways to track it: PCE, CPI. PCE is personal consumption expenditures. It's the Fed's favorite measure because what it does is account for people changing how they spend as inflation rises. This number for the most recent read up 5% compared to last year. Consumer Price Index, another main way to look at inflation, up 6% year over year. Both of those year-over-year trends are well beyond what the Federal Reserve wants to see, an average of 2%, but they're also showing that likely we're past that peak level of inflation. We've already gone past peak, but I think the expectation is we continue to trend in a more healthy direction. But if you look at inflation, you need to understand what's driving these price increases. The most recent CPI release says the index for shelter was the largest contributor to the monthly all items increase, accounting for over 70%. So the sector that we're all involved in is actually being the largest contributor, is really driving these overall inflation levels up. The issue is, if you think about shelter historically, it takes 6 to 12 months to see some kind of slowdown in shelter to actually show up in inflation data, which means maybe the Federal Reserve is making these decisions off of artificially elevated levels of inflation. Now, the good news is I'm not the only one that's aware of this lag. The Fed is aware of it as well. So they are now tracking an unpublished cut of inflation called super core. What this does is it looks at inflation for services and subtracts out energy because it's volatile and subtracts out housing because it's lagged. Where that puts the market is at about 4% inflation. So again, better than that 5 to 6%, but still double the rate that the Federal Reserve deems to be healthy. So what the Federal Reserve has committed to doing is trying to get the economy under control, trying to slow overall levels. And how can they do that? Well, they do that by raising short-term interest rates. So I want to talk about the interest rate hikes through February, and then we'll talk about March a little bit later. When you think about what the Federal Reserve has done, and we say, oh, wow, the Federal Reserve up until March had raised rates 8 times, well, it sounds more dramatic than it is. 3 of them were really to get us back to where we were pre-pandemic. 4 of them were really to get us back to where we were in early 2019. Put a different way, 4 of the rate increases were really just trying to normalize the economy. 4 of them were actively restrictive, trying to slow growth. So what we saw last month is the Fed came out and said to lawmakers in March, the economic data is continuing to be stronger than we expected. Jobs data, inflation data. They said, we're probably going to have to be more aggressive. We're probably going to have to do a 50 basis point increase, really push those short-term rates up in March. They were saying that Tuesday, Wednesday of the week before, or I guess the week of the collapse of SVB. Now remember, SVB, 16th largest bank in the US, 2nd largest bank failure behind Washington Mutual in 2008. Now I'm not going to go through all the details of SVB, but the reason we're still talking about it is we have financial investigators that are trying to make sense of whether or not SVB was just this idiosyncratic, very specific to SVB issue, or is it indicative of something more systemic? Now, if you look at it, there's a lot of reasons why you could argue that SVB was very unique to themselves. They were very heavily concentrated in the tech sector. They had Twitter and WhatsApp messages that caused a little bit of panic about their viability. That caused the run on the bank, and they unfortunately didn't have much diversification in their portfolio and had to sell some of their investments at just about the wrong time, ultimately led to their demise. So you can really argue that this is an SVB story, but a core part of it is that their investments lost value because interest rates were higher, which does make that seem more of a market-wide issue. Ultimately, Federal Reserve, Treasury, FDIC basically said it's not worth the risk of not knowing for sure. Maybe this was just an SVB issue, but they designated SVB and Signature Bank as a systemic risk to the financial system, said we're going to make all of the depositors, not investors, whole. Not investors that made risky decisions, but depositors that trusted in the US banking system were given back their funds. If we think about one of the main roles of the Federal Reserve, it's financial stability. They needed to restore confidence, and that's what they did. Now, as we look at this, we know that over the past few weeks, there's been at least some more quieted talk. We're not talking about SVB every day and regional banks every day, at least the extent that we were. But I would say we're still tracking this because there are still some economic risks related to that. But the Federal Reserve, they stepped back and they said, okay, wow, we saw the collapse of SVB. It's time for us to raise our next rates. What should we do? Should we pause? Should we move forward? And we all know what happened. They raised rates 25 basis points. And I think put a different way, what they said is we feel comfortable that financial stability, at least for now, is under control. What we don't feel comfortable with is inflation. Inflation is still too hot, and inflation is still acting as issue number 1 for the broader economy. Now, here's where things get interesting, because leading into the collapse of SVB, mortgage rates were going up, 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 up. We were about to go over 7%. We probably would have because of the strong econ data. But then when you have economic uncertainty, what happens is investors put their money in the 10-year treasury or the bond market in general. But if you look at the 10-year treasury, that's the one that has the closest link to mortgage rates. We've seen 10-year go down dramatically and quickly. And as a result, instead of us talking about rates that are over 7% today, we're now talking about interest rates that are in the low 6s. And that's where I want to take the discussion to how everything that's happening on the economic front is filtering in to us in the housing market. And so as we talk about rates in the 6s versus in the 7s, you can say, all right, well, affordability challenges aren't as bad as they were. Yeah, that's true. We got to a peak level of the median monthly payment. We've come down from there. Don't want to discount, though, the reality. If you look at the median monthly payment from 2019 till today, we're up 82%. If you look at the national new home affordability ratio. Going into the pandemic, 50% of households could afford the median price new home. Where we are today, it's 30%. So we know that the affordability challenges could be worse, but they've definitely really kind of stretched consumers' budgets over the past couple of years. And as you would imagine, sales have responded accordingly. If you track out existing home sales, down about 23% compared to last year. If you track new home sales, down about 18%. New home sales right now in line with where they were in 2019. You'll hear me mention 2019 many times throughout this presentation because we like 2019 as a healthy, more sustainable point of the housing market versus what we saw in 2020 and 2021 and early 22. So we're tracking in line with 2019 nationally, and check out those month over month numbers, up 14.5% in the existing home market, up 2.2 in the new home market according to Zonda, following a 14% increase the month before. Put a different way, we saw the market respond very notably in the third and fourth quarter of last year, but as we look at where the market is today, spring selling season starting a lot stronger than expected. Now, we attribute this to four main things. Issue number one, or the reason that the market is better, is because partly seasonality. You'd expect the beginning of the year to be stronger than the end of the year. Second reason, acceptance. Think about people that said, oh my gosh, interest rates went from 3 to 6%, they doubled, I don't want to buy a home right now. So they step to the sidelines and then they say, but you know what? I'm pregnant, or I'm retiring, or I'm getting married. And there's if I want to own a home, maybe I'm not trying to time interest rates. Maybe I'm trying to find something that makes sense. We know that there's been some pent-up demand that has driven this level, people that didn't buy towards the end of last year. And I think a big reason we've seen the success has to do with discounts. We'll talk about discounts in just a few moments. But the data that I showed you is through February. That's what you'll find for most of the large data sources given where we are in the month. But if you look at March right now, we have qualitative data from our builder survey that shows still you have a reasonable level, 32% of builders that are saying their activity was stronger in March than in February. But right now you see a little bit of a shift that this survey is for builders and it was captured SBB after SBB. And you can find that about 50% of builders saying that overall levels have flattened out. Now, flattened out at much improved levels, but you can see a little bit of a shift as we went from February to March. So think about how the market has evolved. We said there's four main reasons. One of those four main reasons why the market has been better this year is because of those deals. Back in fourth quarter, we had builders that were saying, you know what, demand has slowed. Let's figure out how to find the market. And unlike existing homeowners that have some sentimentality and some ego related to their homes and what those homes are worth, builders are in a place that they could offer incentives and price cuts. And in fact, as we look at what builders have done, we have 62% of builders that we've talked to that said that they have offered a mortgage rate buy down at a fixed rate. So this is not one of the adjustable, this is fixed rate between the mid 4s and low 5s. Again, this is from our survey. When we ask about pricing, we say, well, what have you done to pricing compared to where we were last year? 51% of builders said they've lowered prices between 5 and 20%. Now, why I think this is worth mentioning is think back to why the market slowed last year. Part of it was affordability, absolutely, but part of it was also confidence. People having FOBAT, fear of buying at the top. And in fact, the number one reason we know renters are renting is because they're waiting for prices to drop. So now what you're seeing is on the ground, builders have, in a lot of cases, found the market. They figured out what makes sense to get consumers off the sidelines. Now, we ran some numbers to say, well, what might an adjustment look like? And we said, what would it take to get the monthly payment back to where we were at the beginning of last year before we had the rate increases? Now, across many markets, if you just did a price cut alone, that would be about a 20% price cut, get you back to spring selling season of last year. When we were approaching 7% interest rates, it became a little bit more challenging because we were now talking a 25 to 30% price cut. But as we look at this, I'm saying getting back to spring of 2022, again, before the rate increase, but that's more of an art than a science. That's us saying what is kind of an arbitrary benchmark, although not entirely arbitrary, but where do we think prices or payments might need to go to re-attract buyers? But we know that when you do dramatic price cuts, sometimes it works, sometimes it leads to higher cancellations. We saw that higher cancellation rate last year. What we saw a lot of builders do is say, okay, well, what's the biggest driver behind the consumer pulling back? And what if we drop prices a little bit? So help with that consumer confidence mentality, feel like you're getting a deal, but also help with the monthly payment. What we found is just a 5%, in some cases 10% price cut, combined with a mortgage rate buy down of 5%, gets the market back to where it was spring selling season of last year. And we've seen that pretty immediate response to consumers saying, okay, there's some price elasticity. I feel more comfortable with the market. I'm willing and able to step back in. Now, a question we've had is, why would builders be willing and able to do this? And I think you also need to step back in time. Think back to third and fourth quarter, depending on the market. We started to see quick move-ins rising and rising quite quickly. Now, remember what quick move-ins are. These are homes that can be moved into within 90 days. A lot of these homes were hitting at just about the same time that demand was slowing. We saw QMIs build up. Builders said, uh-oh, don't want to have too much standing inventory. They started to offer the incentives, and we've seen this number almost immediately reverse course. Right now, weekly quick move-ins up 33% compared to 2019. QMIs are not inherently bad. We know that some people want to move in soon. We know that QMIs are great for some consumers. It just depends on what's the concentration of the QMIs, how many in the community, what's the price, and how is the demand there. What we know across the country is we have about 40% of builders that feel uncomfortable with their QMI level, 60% that feel comfortable. And I think there's one really obvious reason why having QMIs actually makes a lot of sense right now. And that's because there's nothing on the resale side. Now, a little bit later, I'll show this data by market, but for now, I just want to stay high level, show it on the national view. Here, look at 2023. Good news, we're above where we were the past 2 years. Bad news, still well off where we were in 2019. We know that active listings are remaining extremely constrained, and I think we can understand why someone may not want to list their home right now. We have some people that don't want to reset their current mortgage rate. Why do I want to sell and maybe pay more money and have to take on a higher loan cost? There are some people that are saying, well, I can stay put and maybe it makes sense that I should remodel now. Again, we'll talk about that a little bit later. And you have some people saying, well, I have this low interest rate, maybe I can tap some equity, move into a different home, but also turn my home into a rental, which basically pulls from the supply pool, but also adds to the demand pool. Active listings extremely constrained, and one huge beneficiary of this, which is the new home market. As you look at new homes as a share of overall inventory, we were looking at 10 to 15% historically in terms of the new home community. Now, builders represent over 30% of the overall inventory. For consumers that want something, in some cases want to move now, those QMIs make sense, want something turnkey, want something nice, the builders are able to provide that. But I think this is where we need to take it from the high level discussion to a little bit more localized. We know that there is a regional difference going on right now. And I will give you kind of the conclusion to why we think it is happening at the beginning, which is we've spent so much time trying to say, why is the East doing better than the West? And the one indicator that seems to be the most telling is payment to income. So here what you're tracking is in 2010, the payment to income ratio, just telling you where we're coming from. The darker the color, the more saturated the red, the more stretched the payment to income ratio is. The lighter the color, the more healthy, the more reasonable we were at. 2010, probably no surprise to anyone, coasts have a little bit more of stretched affordability, but generally speaking, we had affordable housing across the country. When you look at where it is today, you can see a lot more of the saturated red, a lot more of the brown. You can see basically nothing that's light, with an exception in Texas as you go Texas west. As you look over to the East Coast, there is some brown. Miami's definitely in the darker color, but you see a lot more of the lighter. I think this is one of the clear divides that drives the East and the West. But my focus in this section is to compare and contrast Texas West versus what we're seeing in the East. So as I go through these slides, I'm going to show Texas West on the left-hand side, East on the right. I'm not going to show every market. I'm going to show a lot of the top markets across the country in these areas to help understand what's going on. What are some of those regional differences? And the place that I want to start is just looking at the unemployment rate, because this is one thing that we thought, okay, well, maybe employment's the reason that there's such a clear divide. But if you look at the West versus the East, the dotted line is the national average. You're basically seeing that both sides of the country are operating with pretty strong economies. The reason LA and Las Vegas are higher is because the leisure and hospitality sector of the wider economy has been facing more outsized labor shortages. It hasn't fully recovered from the pandemic. You have more leisure and hospitality in those two areas. Across the board though, healthy, good unemployment rates. We then said, okay, well, maybe part of the difference has to do with the share of high income jobs. Dotted line shows you high income jobs where 100 is fully recovered from the pandemic. Over 100 is that you've seen additional growth. Again, if you look west, if you look east, you find pretty much the same chart. So the economy is not really the issue when you're looking at the overall backdrop. And yet we do know that sales are looking a lot different. So here's the average sales rate. Many of you know that I like this number. It is sales adjusted for supply. We don't care how many homes are available. We're just saying if a builder is willing to sell a home, how well can they sell it? Again, compared to 2019, we like that, a healthy, a sustainable, a good year for the market. A divide even within the West. As you look to the left of the dotted line, Salt Lake City, San Jose, Austin, San Francisco, Phoenix. These are some of the markets that throughout last year, they slowed the most dramatically and the most quickly. And while they're still performing below 2019, if you've tracked their trend, they have done so exceptionally well over the past few months. There's been such a rapid rebound in these areas as, again, going back to the deals, the builders have done a pretty good job of finding the market. Markets to the right of the dotted line, you're going to find a really interesting thread with California markets. San Diego, Riverside, LA, outperforming 2019, seeing pretty reasonable overall average sales rate numbers. In some of these markets, we have seen prices come down, but inventory is so scant that it's allowing for builders to be able to have reasonable sales. If you track out the East, here, the dotted line, you don't have anything to the left of the dotted line, showing that the markets we're highlighting here in the East are either in line with or outperforming where they were in 2019. Miami, you'll see Miami just rises to the top of most of the metrics that we're looking at. I'm doing a presentation in Florida next week, and we looked at some of the data behind Miami. Over 70% of the home searches in Miami are coming from outside the market. So I think that that's contributing to the higher sales rate, the higher level of home price appreciation, the fact that income looks out of line. It's partly because it's not the locals that are buying there. So if we look at appreciation, I want to start with the new home price changes, then we'll go into existing. When you look at the West, you do see that prices have come down in some cases, not that dramatically, San Jose a little bit more. But if you think about any cycle, when interest rates are going up, higher cost areas do normally have an outsized impact. You do normally find that when interest rates go up, you have a higher base price that's going to cause a greater change in the overall payment that's going to impact price. So we saw that really play out here. If you look at the East, we don't have any of the markets right now that are posting a negative year-over-year change. Some month-over-month, but not at the year-over-year. Again, look back to Miami, 16% growth compared to last year. But in general, we're talking single-digit growth in the East and single-digit growth in the West with a few exceptions on the new home side. When you track it out for the existing home side, very similar to what we saw on the last slide, you are seeing some price drops in the West, not uniform, depending on the market that we're talking about. In particular, Northern California, Seattle, not doing as hot as some of the other markets. If you look at existing home price appreciation in the East, oof, look at the double-digit consistency here in the East for entry level. One thing I should make clear, when I say bottom tier, middle tier, and top, I'm basically saying entry level, move up in luxury, and we have that adjusted for each market. So I'm not trying to gauge any market against each other, I'm gauging a market against itself. So we see that entry level is the most desired product. I think it's really kind of revealed preferences by the extent of home price appreciation. We also know that there's just a lot of groups that are vying for the same product. You have investors that are looking at entry level, people that are looking to buy, turn a home into a rental. You have lower income individuals, you have first time buyers. It's just an attractive category that's difficult to build. Now, again, if you look at the West, we haven't had that much product below 300,000 even in 2019. In Texas, yes. In Phoenix and Vegas, Salt Lake City, yes. Not really in the California markets. As we track that out today, you're seeing it's just becoming increasingly rare in the West to have anything below 300,000. We like it as a general entry level gauge. When you look though over to the East, going into 2019, lots of markets that had a reasonable share, 30, 40, 50% of the projects under 300,000. Part of the reason people wanted to move there is, wow, all of a sudden bang for buck, all of a sudden you can find so much more affordable housing. You can see even within the East, that has become an increasingly rare product as well. When you roll it all together and you say, okay, well, we've seen that sales have come down compared to the past 2 years, in a lot of cases above where we were in 2019, which feels like a pretty healthy, pretty reasonable place for the market to be. The response that we need to expect is if we're not selling as many homes as we were last year or the year before, we probably won't have as many starts as we had last year or the year before. So as we track out the housing starts again in the West, you're finding that across the board, starts are down, makes sense, sales are down, realigning those two numbers. Now know that that's fourth quarter annualized, so we're comparing to where it was last year. If you look at the East, similar, because the market, even though it is running hotter, it is still slower than where it came from. The exception is the second one on the list here, Orlando, not shown Sarasota. Sarasota is also posting gains in terms of housing starts compared to last year. Now, fourth quarter data, that's the most recent available, but what we know is because the spring selling season started stronger than originally expected, more builders were planning and are planning to start more homes than originally expected. The idea of realigning starts and sales works both directions. Sales down, starts can come down. Sales up, starts can go up. But there's a little bit of a question just related to tightening credit conditions. Doesn't sound like it's widespread at this point, but if you think about the first section talking about the wider economy and thinking about how that can filter into other parts of the market, it's still something we're watching. Maybe there's a desire to get the home started. Maybe there's a little bit more of a struggle related to financial conditions. But as we've talked about before, starts are great. Starts is telling you what's going vertical, but then you also want to look at, well, what lots are available for these homes to be started on, period. And we know that during the pandemic, besides not having enough materials, besides not having enough workers, lots was a big holdup as well. Vacant developed lots, VDLs, lots that can go vertical tomorrow. Current VDLs is going to be, I don't know if you can see my mouse, but it's the current VDL column is showing you where we are right now. If you track out the East and the West, you're basically finding all of the markets are below where equilibrium is. Equilibrium will depend a bit on market, but just general rule of thumb, think 24 months. We have 5 among all the markets here that are within a reasonable range of that overall equilibrium, but we know that VDLs are still extremely limited on the ground today, improving, seeing an uptick, but not really supportive of too much starts activity, though because starts have come down, this has allowed this to catch up. So in a weird way, slower starts has allowed for a little bit more health to return to the market. All right, so we looked at starts. We looked at VDLs. VDLs can turn into a start right away. Then you go back one step further, total upcoming lots. Upcoming lots are lots that could turn into a VDL, in some cases within the next 3 months, in some cases within the next 18 months. You can see in the West, not much growth. Salt Lake City stands out for a massive change compared to last year, but you're kind of talking plus or minus 20%. When you look at the East, a lot more double-digit increases, lots of land and lot development trying to support overall growth. So we know that builders are reacting to sales. We're seeing some lots coming online, should be good when builders want to pick up their overall starts activity. But then you also have to think back to resale. This is how builders are gaining shares because resale is so incredibly constrained. And again, it doesn't really matter, similar to the employment data, it doesn't matter if we're talking West or East. Active listings, here looking at some of the top markets in the West, range from down 5% in Austin to down 50% in San Diego, in LA, Riverside, Sacramento. We talked about the inability to get more homes built there and also the extreme constraint on overall listing activity in the resale side. If you look at the East, again, similar, down 20% on the low end in Nashville, down almost 60% in Philadelphia. So as we look at supply, we've taken a look at new home supply will kind of vary, depend on financing and depending on demand. We know that resale inventory is being constrained for a lot of reasons. I think one of the most notable, not wanting to reset the rates. Then we can also look at inventory in the multifamily side. Now, this is another one that just totally depends on where you are. If you look to the far right, we're going back to those California markets, you have 2, 3, 4% of the overall existing rental inventory that's under construction. So barely going to move the needle. If you go over to the left-hand side, you have higher levels, Nashville, Charlotte, Austin, Raleigh, almost 14, 15, 16% of the overall existing rental supply that's under construction. Now you can argue this is needed. Those are some of our high and top migration markets, but we're watching the pipeline in some of these markets where there's a high level and checking to see if there's any kind of near-term impact on multifamily development. We know that there are some capital constraints because of the Fed raising rates, and then we're going to see how these new apartment communities come online. As we go through our final 7-8 minutes here, I want to do a quick hit on remodeling and then share some final thoughts. And the reason I thought remodeling made sense is we've talked about people staying put and people trying to decide what do they want to do with the home. And one of the things when you stay put is that you may want to put some money into the home. You may say, hey, you know what? This rate is at 2.7%. I'm probably not going anywhere anytime soon, so I'm going to turn this into a home that I really want to live in. We know that it could be people staying put. We know it could also be people looking to buy. Turnkey homes today are expensive. If you're willing to take a home that needs to be remodeled, maybe you can get a little bit better of a deal. What we asked in our survey for consumers is, are you willing to buy a home that needs to be remodeled? 80% of our respondents said, yep. Some of them are enthusiastic about the idea. Some of them are saying, well, yeah, I'm going to take a remodel as long as I get a little bit of a discount on the price. Now, that qualitative information matches up very closely with the quantitative information that we have from Todd Tamilak. Todd is our building product expert, our remodeling expert here at Zonda. And what Todd says, and I'll tell you, the first part of this is catchy, the second part not so much. Todd says we are in the golden decade for remodeling, catchy, with a little bit of a recession in between, not catchy, but you get the point. He thinks that there's so much opportunity for remodeling. It's not completely recession proof, but he thinks as we look over the next 10 years, there's so much opportunity. Part of the reason he says that is just looking at the chart here on the right. This is showing you single family homes that are in prime remodeling years. Todd classifies those as between 20 and 40 years old. Look at history, look at everything from 2020 to 2000 to 2020. Not that much growth, nothing but a straight line up as we look out through 2026. So huge opportunity here that will depend on the market you're in. So make sure you check if you are focused on remodeling where the biggest opportunity is. Census has the data of share of housing stock by year built. This is obviously a larger frame than what Todd says to look at for those prime remodeling years, but it can tell you a lot about that remodeling potential. Todd's forecast for remodeling is that this year it's down 7%, largely because of his expectation of some kind of economic recession. But then he has growth in 2024 and even 11% growth going into 2025. Todd breaks out remodeling by 3 different sections: maintenance and repair, so small dollar amount; mid, which is no structural remodels or additions; and major, so something like you would see on HDTV. As he puts together his forecasts, he sees that each of those are down, at least through the third quarter, seeing a flattening out of that minor repair and mid-range as we go to the end of this year, seeing growth for each of the categories, but lagged with the major until we get towards the end of next year, seeing so much growth in this group taking on. He thinks this is partly because major has a little bit more of an impact to any kind of economic volatility. So we understand Todd's broad thesis, very enthusiastic about the remodeling space. And so I asked him specifically, okay, what are the 5 building products that are expected to outperform over the next 12 months? He said number 1, and I would say almost hands down number 1, is windows and doors. And it's for 2 reasons. Windows and doors gain share as mobility drops, which is what we've seen and what we expect to see because of the rates, happened during the great financial crisis, but also window and door spend grows in years following big swings in weather. And we know that there's been a lot of severe weather events, which should be a positive for the window and door category. His second category he likes is garage floor coatings. Third is that mid-priced remodels of kitchen. So you saw mid, you saw it on the slide I just showed. So not structural, mid-price, not as sensitive to some of recession changes or economy changes. He likes mid-price remodels. Cladding as number 4, which is very interest rate sensitive. And his 5th category that he likes is HVAC. As we look at all of this, we have 3 minutes and 2 slides to get through it. I want to go back to the broader housing market, where objectively you cannot argue that housing is up from bottom. We slowed last year, pretty dramatic pullback. We've seen the improvement as builders have found the market. We've seen that uptick in activity. Now, I think from the housing point of view, it's easy to be really enthusiastic about that. Unfortunately, I'm an economist who thinks the boogeyman's always coming after us. And so I just want to make sure that we're aware that there are also other things that we should be watching. So yes, housing market's coming back, things are moving great. Let's make sure that we keep an eye though on Fed policy, because we saw a lot of us, probably myself included, didn't know who Silicon Valley Bank was or didn't know the holdings of the bank for sure a month ago. There are things that when the Fed raises rates that could cause some parts of the economy to break. When we look at consumers, we know that consumers are changing and evolving. We have consumers that are now saving less and putting more money on credit cards. Right now, defaults, delinquencies, healthy, not concerning whatsoever, but the point is, what are we watching? Does that ultimately change, or do consumers stay within a place that they can continue to service their debt? And finally, the office market. Really probably no surprise to anyone who's read any articles over the past few weeks. Office market is a little bit of a concern related to overall occupancy levels and refinancing of debt. So we're watching this, we're tracking what this might mean for the housing market, for the broader economy, but we also remain extremely enthusiastic about how the market might progress. Once we get past some of the uncertainty, once we work through some of this, we know from our consumer survey that we have the highest share of millennials, the largest living generation, that want to buy a home over the next 1 to 3 years, waiting for prices to drop, waiting to save for a down payment, waiting to see more inventory. It's not just the movement of millennials. We know that the group of Gen Z, the group that follows, they're turning in their early 20s. They're expressing a lot of interest towards homeownership. We know there's a lot of moving parts. We feel positive about the demand once we can get to a place that incomes and home prices are better aligned and that people feel more confident about where the market is. So with that, I will stop and I'm going to check for if we have any questions. Remember, we have about 5 minutes to go through questions, so if you have any, please feel free to send them over. Okay, so one of the questions that we got through is probably more technical than what I will be able to share, because someone's saying it doesn't really make sense if shelter is responsible for 70% of inflation. Why does Supercore only go from 6 to 4% when shelter is removed? I think that there's a lot of moving parts when you're looking at the data here, where that single month it was 70%. I don't know how much they change the weightings, if at all, when they do Supercore, but I know in general, if you look at shelter's long-term share of the overall market, it's 40%. So it could be just different numbers. Maybe it's a 70% growth rate versus 70% of overall activity, when in total it's 40. I think that becomes, again, probably more technical to answer here. Fair question, but that is how the data is calculated, that it does come out from 6 to 4, but thank you for asking that. Okay, there's another question also about shelter inflation. That's funny. Okay, so this question is saying, how is shelter calculated in the CPI for inflation? It's my understanding that CPI tracks rents, not necessarily home prices. As interest rates rise, fewer people can afford to purchase, thus driving more people to rent, which I would think drives rents up, which would make rising rates counterproductive. It's an interesting thought process, and I have a lot to say about it. Let's start with how shelter is calculated in CPI. The way that it's calculated is twofold. So yes, it does. It's actually, I think there's 5 different ways that they include shelter in inflation. But one of them is rents, as this question said. One of them is owner's equivalent rent. So owner's equivalent rent is, I own my home. I get a call from the government agency that says, hey, what do you think you can rent your house out for? So they're trying to remove the fact that housing is both consumption and investment. And so they are trying to capture the for sale side, but they're capturing it by generally capturing rents. The second part of the question is the one that I have issue with, which is, doesn't higher home prices push more people into renting? Our belief is no. We know historically that when the housing market slows, the rental market isn't just running away and having a gay old time and thriving. When housing slows and rental slows. It's not that all these people flood into the rental space, it's that you have more people that are quote unquote stuck in rental. Maybe they're choosing to, but we're assuming those that want to move out become stuck. But there's a third option that I think people often forget. You can rent, you can own, and you can move in with friends and family. And what we know is during periods of high shelter costs and high home prices, people recouple, people move in with friends, family, roommates, whatever it may be. We are already seeing that rent growth is slowing compared to where it was. So I think that's probably the key thing I have is don't assume rental does well when for sale doesn't, because that's not how it traditionally has worked.
Excellent. Thank you, Allie. This is Jack Mannon, Director of Brand Marketing Communications. In the background here, thank you for everyone who's been giving some good questions. I'm going to let Allie get caught up here as she reads through them. But one I've gotten several times here is, will these slides be available? Yes. Early next week, both these slides and the recording of today's presentation will be made available to attendees. Allie, I think we have time for just 1 or 2, maybe 3 more questions here at your leisure. So take a pick from what just was sent your way.
Cool. An easy one to answer is talking about cladding and the relationship with interest rates. For the individual that asked this, please email me, awolf@zondahome.com. I'll put you in contact with our building product experts, and he'll be able to explain more of the logic behind that. Another question, do you see 30-year mortgage rates dropping below 6% anytime soon? And what I will say is, shame on me, because every single day I check what the 10-year treasury is doing, except today, which is weird, but I was prepping for this. So 10-year treasury right now has gone down since I pulled that yesterday. I was showing 3.3, now it's 3.28. If we continue this path on the 10-year, which we might, depending on what happens with the jobs data tomorrow, and we should be getting inflation, the CPI in the next week or two, yeah, we could see rates below 6% if we see that investors still feel a little bit concerned about where the market is. I think that's a little bit of a tricky thing for our industry, is in an environment like today, rates are going down because it's saying, hey, we're a little bit nervous about where things are going. So good for affordability, but a little bit of a challenge when you look at the broader market. Two questions actually asking basically they're actually asking different things. Two questions related to the Fed. Question one, do you anticipate the Fed to increase rates at the next meeting? Yes, I would imagine 25 basis points unless tomorrow's jobs report is really slow. We see negative job growth or 100,000 jobs added, something like that. Maybe they would change their mind. If inflation all of a sudden shocks and is a lot lower, then I also think that this would be, the Fed would pause. But as long as the data continues to move in the direction that it is, they've told us inflation's more important than anything else. So I think they would rise. Jack, I'm going to answer one more question, and then we'll probably at time, you can see if there's any questions for your team too. The last question is, what's your confidence level in the Fed's skill and ability to manage inflation without wrecking the economy? Let's let statistics drive that answer. Of the past 11 times the Fed raised short-term interest rates, I think 3 times they've had a soft landing. So it's not that the Fed wants to do anything but have a soft landing. It's just extremely difficult to navigate, especially when data is incredibly lagged. So Jack, let me turn it to you.
And I'm going to turn it to Tim Page to.
All right. Yeah, very good. All right, Jack, thank you. Allie, thank you. That's tremendous information, very insightful. You're an absolute professional. We look forward to you joining us again for another call coming up soon. For everybody that participated on this, thank you very much for taking part. Thank you for your partnership with BFS. I know we have a number of builders and suppliers on this call. We look forward to seeing you soon, and hopefully you're able to join our future calls. So thank you. Have a great day, everybody. Bye-bye.